Good afternoon, everybody. I hope you're having a great Saturday. Today, we're going to build a DCF model for IBM. We're going to start with a blank spreadsheet and hopefully be able to ascertain the fair value for the company. So let's get straight into it. As you can see, the last couple of years, the stock has soared, going from about 125 up to, over 300 now. It did drop a bit on recent earnings because there was a doubt about their, hybrid cloud performance. But then they announced the partnership with AMD and the stock pulled back up. And so again, just like Google, just like Apple, it's at all-time highs. So let's dive right into it. Open up your spreadsheet. As always, page layout, remove those grid lines, view, freeze the first column, insert another column, make the A smaller and the B larger. And to get the financial statements, you go onto the SEC website, search for IBM. It was posted on the 23rd of October, so it's at the top there. Open that one. Annoyingly, the 10K is not on here. You can't find the actual financial statements. So go on to IBM's Investor Relations, go for 2024 IBM Annual Report, and on it, open up and come to page 69. But the actual page on the PDF is it doesn't say. But just go 69 and pull up this section here, disaggregation of revenue, and that's where we will start. And I also have the 10Q open here for the first 9 months. So the way we're going to do this is we're going to go by these three revenue segments. Software, consulting, infrastructure, and financing, and obviously other. That's 5. But we can't go into each of these individually because they report them differently on this page. Therefore, we won't be able to do a like for like. I think we'll have to do that when they release their next 10K. So we'll just go with these 3 now, and hopefully it will save us a bit of time. But if you want to do that by yourself, feel free to. I think it's the more, granular that you can get into it, the better. So I will zoom in to about M, I think. Go equals. No, actually, just type in IBM. Data. Stocks. There you go. Ticker, date, current, implied. And we want to know if there's any upside or downside. Just do some formatting. I like to go for this beigey color. Border, a dotted border. And just copy these over here. Take this and go there. Now, pop an X here. Just center it. Fill. Put that in white because we're using the dark navy as the background. This section is going to be called assumptions. And we start with revenue segment. And that is just going to be these 5. Software, consulting, infrastructure, financing, and other. Software, consulting, infrastructure, financing, other. Bold them. Here we want EBIT. We're doing free cash flow to the firm, so we're trying to calculate the cash flows generated that are available to both the debt and equity holders. Then we want the WACC, the weighted average cost of capital, then the terminal growth value. There we go. Here, write switches. Then we want a bear, base, and bull. These switches are going to allow us to toggle between these 3 different scenarios. So if we're not optimistic about the company, that's the bear case, and that will obviously make revenues lower. The base is what we think is going to happen. And then the bull is if it exceeds our expectations. Just copy these down like as so. Come up. There we have it. In here, just put everything equal to 2. Leave these 2 blank though. Okay, now we're ready to start building out the revenue build. So go revenue build, and we know there's 5 different segments that we need to cover. These 3 are the main ones: software, consulting, and infrastructure, financing, and others. It's marginal, but we still have to put it in as a because it's there. Equals B10. Put this for these. Put the title equal to the cell at of what is in the assumptions, just so if the segment changes its name to something else, say that it could be software and AI, then we just change it up here, and it will automatically update down here. It just makes life a lot easier when we come back to update our models. It's good. Percentage of revenue. Okay. We're going to start in 2022. In the cell after you write 2022, so go equals, select the 2022 cell and just go +1. Pull that all the way along. I always do this. I always go 1 too far. So we are calculating 5 years out: 26, 27, 28, 29, 30. Software. So total software revenue for 22, 23, 24, we have 23 billion, 25 billion, 27 billion. 23, 629, 25, 011, 27085. Just do a bit of formatting to make this look nice and clear and presentable. Well, that's not doing it if I go to 4 decimal places. Use a 1000 separator, and negative numbers need to be in brackets. To calculate the growth rate each year, we go equals, take the year that we're in, divided by the previous year, -1. And so, as you can see, that's a 6% growth. Copy it, copy it across. There we have it. Now for 2025, we come over to the 10Q. We can see 2025 so far on total software, they've done nearly 21 billion. By this time last year, they'd done 19 billion. So for the first 9 months of the year, they'd done 19 billion in revenue and finished on 27 billion. We now take the 2024 total figure, divide it by 19,162, gives us 1.1413, and we'll take that and we'll go 2932 multiplied by 1.41347,459. It doesn't have, I get it. Oh no, that's not good. Column width, fix it, come back to 10. There we go. So for 2025, we expect revenue to be 29.5 billion, which is nearly a 10% growth. Come up here, copy those 3 cells, and cover this where it says bare base bull. Cover this area up to 2030 from 2026, as so. To forecast the next year's growth rate, we'll go equal average, and we'll take the last 3 years. So we'll say 8% growth for next year, and this will settle at, let's say, 5%. G10. So make this cell equal to this one. And actually, just this needs to be percentage. That's how we want it. Perfect. And we're saying For next year, based on the average of the last 3 years, we'd expect 7.79% growth. We are saying that by 2030, the growth rate for software will reduce down to 5%. So the way we calculate these next three are, we go equals, we take the previous year minus, open brackets, the previous year minus the final year, close your brackets, divided, open brackets, by 2030 minus 2026. Now, we want to reuse this for our next revenue segments to make life a lot easier for us. So we need to lock in a few of the components of this calculation. So leave it like nothing on the on where it's G28, nothing on this one, but we want the K to be locked in, but not we want the column to be locked in, but not the row, because we want it to dynamically update as we go down. We want this one to always be the same, K23, because it will always be 2030 minus 26, 27, 28, etc. And for G23, we want the row, but not the letter, because we want this to go down the line, but we want the row to stay the same. So lock in the row, and there we have it. Now just copy it, pull it along, there we have it. So in terms of what we anticipate as a bear case scenario, we'll say 95% of this 5% of these growth rates. The bull case will put 105% of the growth rates. So to calculate that, for the bear, we take the base, multiply it by the bear, lock it in. And when I say lock it in, it's you put a $sign in front of the E and a $sign in front of the 10. So a $sign in front of the column and a $sign in front of the row. Pull it along. We do the same for the bull case. Again, lock it in. And there we have it. Now, we want to be able to flick through each of these scenarios. So if the growth rate is 7.4%, we want to be able to toggle that. That will be 1 for the bear case. The base case is 2, and the bull case is 3. So to be able to toggle through using the switches up here, we go equals, offset, select the cell that we're in this case it's G26, select the switch, C10, then comma, 0, and end it with a 0, and there we have it. So, I mean, obviously we're not doing this to any decimal places, but if I wanted to go 1, a bear case scenario, it comes down to 7. If I wanted to come to a base, it goes back up to 8%, as it does for the if we go on to the bull case as well. So pull that along. Now we want to calculate what the revenue for the software segment will be based on these growth rates. So you take the previous year, multiply it by 1, open brackets, 1 plus the growth rate. All those across, and there we have it. The revenues for those next 5 years that we're forecasting. And remember these numbers because this is the base case. If I see, it comes down. If I go come back to the base, let's go to the bull. See, and it goes up. And we do that so that we can, just by going up here, we can flick these switches and the whole spreadsheet is dynamically linked and it will update what the current price is. So we could be like, oh, I think we could be really bearish on IBM based on these figures, and it will tell us what the implied price will be. Or we could be like, oh, we're really bullish, and it will update that. You'll see again, all at the, once we've built out the model and how it links dynamically. Okay, so let's do the next, let's do consulting, the next revenue segment. Just copy this down because the formatting is good. There'll be a couple of things that we need to change in that we have to remember, and I always forget to do it, and I end up coming back to it, but we'll do it here. So total consulting, it stayed fairly stable the last 3 years. You'd have thought it would have gone up significantly more with AI implementation. 2692. Come on to here, total consulting. So again, it will end this year at about the same amount. Just let's work out, and we'll multiply 1.3335 equals 15,706 multiplied by 1.33350,519. Okay. So for next year, we're anticipating a smallish growth of 1.5%. And it's possible that this doesn't grow, but let's put it at 0.5%. And make sure this cell equals this one. Now, I think by and large, all of these are going to be the same bearish and bullish scenarios, unless we see something specific in the revenues. We'll go with that. So what do I want to do? That's it. We want this, change it to E11 so that it corresponds with the correct cell. Pull it across. Do the same with the bull case. Pull it across. Do the same for the switch. There we go. Yeah, it looks like we've got it right. Methodically, not necessarily in terms of what we have forecasted. Equals B12. Infrastructure, is that right? Yes, it is. Infrastructure. Well, this is actually going down. They've estimated 5% growth for revenue next year, and that looks like it has to come from software, because the consulting is flat. Infrastructure looks like it's on a downward trajectory. 14,593. 14,020. Infrastructure, previous year, divided by 9,764, 1.435. Let's go 10,586 multiplied by 1.43588693. Okay, well, I mean, it grew at 8% last year. Let's be a bit more generous, and instead of averaging from the last 2 years, from the last 3 years, sorry, let's say this is, let's give it a 5% growth. Because if last year was good, we'd presume next year, well, we could think that next year is going up as well. And then we'll end it on a 1% growth rate. G12. There we go. Now the last two, but instead of copying that one, because we've edited the average for next year, come up to consulting and just copy it down. Go financing. No, sorry, B13. Did I do that right here? Yeah, I did. 645. 741. 713. Financing. Okay, let's see what that number is. 543. 1.313 equals by 1.31307551. Okay, and let's put 3%. Put it across. When you're doing these quickly, always make sure that you're double checking that you're making sure each cell, well, the cells are linked to where they're meant to be when you're copy pasting, because it can, otherwise it will upset your model. Oh, why am I doing? Sorry. 909632243. 909632243. Okay. Divided by 214. There we go. 1.68 multiplied by 1.13. 551402. Just change this to 1%. It's really insignificant in the grand scheme of things. We don't have to worry about it. It's pointless even doing a switch. Say 1%. G14. With these, sometimes when it's so low, and you're seeing these big swings of 30%, 60%, or sometimes it could be like positive 50, 60%. Don't put those in the forecast, because over 5 years, if you grow, say, 77 million by 50, 60% a year, it suddenly becomes massive. It snowballs. So just put it, just keep it very insignificant, unless you've heard otherwise that it's going to be a big star in terms of the revenue, in terms of the revenue performance. So now just draw a border under all this, and we'll calculate what the total revenue is. To calculate total revenue, we just sum up each revenue segment. There we go. Bold it, pull it along. Let's see what the percentage growth is. Yeah, okay, this is good. They're forecasting 5% revenue growth anyway, so we don't need to make any adjustments to what we've just done up here. Okay, come up. We want to build out the income statement now. And the income statement is the revenue, the EBIT, and the taxes. Put your revenue equal to what we've just calculated. EBIT. So the EBIT, come on to page 48 of the annual report, and it's on page 3 of the 10Q. So what do we want from here? We want income from continuing operations before income taxes. EBIT is earnings before interest and taxes. So we actually have to add back in the interest expense. Yes. So it's income from continuing operations before income taxes, and we add back in this interest expense. So equals 1156 plus 1216. That's not, I mean, other companies will usually have operating income, which is your earnings before interest and taxes, and they'll have that clear rather than the way IBM are doing it. I'm not too sure why they do it like that. Maybe it's because of, I don't know. Well, if anybody knows, put it in the comments. Equals 8690 plus 1607 equals 5797 plus 1712. To work out the EBIT margin, which is the percentage, we just work out what that is as a percentage of revenue. So you take your EBIT, divide it by the revenue, and there we have it. 4%. You can pull that up to 2025. Let's calculate what the 2025 figure is going to be. So we have to do 7509 divided by 2491 plus 1288. Okay, so we then take, where is it? 6185 plus 1457 multiplied by 1.98703361. Okay, well that seems a bit healthier. This wasn't, I wonder why. It wasn't doing very, the margin was quite low and it was fluctuating as well, 4%, 17%, 12%, now 23%. It's not, you want to see that a lot more stable. Let's take the average of the last 3 years and just pull it out so that we'll settle on maybe a between 17 and 19% EBIT margin. To work out what the EBIT is from 2026 onwards, you take your revenue, multiply it by your EBIT margin, pull this across, there we have it. Now we want to look at taxes. Taxes, we need to know what they are as a percentage of EBIT. So come back onto the income statement. Provision for income taxes. So when this is in brackets, it means they were given it. There was a rebate there. It's a negative number. This means is when it's without brackets, this means taxes they've paid. In brackets, it's taxes benefits they've received. So 218, sorry, minus 218. No, I got that wrong. It's 626 minus 626. 1176. Minus 218. So I mean, this doesn't really tell us anything here. 1193. Let's do it half. Let's put this at, it's 1193 now. Let's just multiply it by 1.3. Actually, the better way to do this could be divide by 4 multiplied by 3. No, sorry, it's the other way around. It's divide by 3 multiplied by 4 to get an annual. I mean, yeah, it's doing well, so it's going to pay a proper tax this year. I guess maybe down here, the reason it was so low is because a new CEO did come in around this time, and he probably just had to mark down non-performing assets, which then do affect profitability. So yeah, that could be one of the reasons. Cash flow items is next. And this is your depreciation and amortization. We want to know what that would be as a percentage of revenue, as a percentage of capex too. Capex and change in net working capital. Looks good. DNA. That is on. Okay, here's your balance sheet. We'll come back to this later when we work out what the debt is. And here is the cash flow statement. We want depreciation, and this one as well, amortization of capitalized software and acquired intangible assets. Then payments for property, plant, and equipment. That's the capex. The change in net working capital is the sum of these 5 here. So let's start doing that. Okay, DNA. 2407 2395 equals 2407 plus 2395. It's a percentage of revenue. We can just pull this along. It's going to look messy. Actually, no, it's not. It's fine. This one will be 4802. We want equals 2287 plus 2109 equals 2168 plus 2499. Okay, come on to the capex. 1346. $1,245, 1048. I mean, the cash flow is going to look really good here because depreciation is so much higher than the capex, which I guess is good for the free cash flow. But eventually, if you're not reinvesting in the company, you're going to come unstuck. So equals sum, and remember it's the sum of these. So minus 539, comma 331, 71, 126, 213. Equals sum 725 negative 462, 390, 1466, 65. Yeah. Equals sum negative 374, 265, negative 166, 1601, negative 13. Let's see what this is, a percentage of revenue. Okay, 2025. Up to the cash flow statement, below the balance sheet. There it is. These two. Okay. So if we do divided by 1644 plus 1910, yeah, 1.31, 1698 plus 2027 multiplied by 1.31316826. Okay. Just for 2026, just take an average of the last 3 years, pull it across, take the revenue forecast and multiply it. Okay. Now for CapEx, do the same again. CapEx divided by 745. 709 multiplied by 1.4061141. This is wild when you think it's a tech company. It's so important in AI. We remember where we were looking at Google, Facebook, Meta, all of those other companies apart from Apple, the amount of CapEx they're spending as a percentage of revenue, it's phenomenal. I think Facebook's was about 35%, and then IBM is like 1 or 2% depreciation, being really, really high. So yeah, it's interesting to see. Okay, now I'll change in net working capital into this one here. We'll just do. Let's just leave it at negative 804. Okay, those are the cash flow items. Let's move on to the actual DCF now. I know this is a lot of repetition, but it does. There's a reason for it. All the way it's dynamically linked, etc. Yes. So okay, we're just going to make this equal to the revenue that we have up here. Pull it across. Keep going. So equals. Now for the EBIT, we're going to do a bull, bear, and base case scenario for this one, so that we can toggle with the switches. Because your EBIT margin is, along with the WACC and terminal growth value, are the 3 biggest drivers, more so than revenue, on how the company is, on the valuation of the company. So as we've done, make this again equal to here, but only pull it up to 2025. Below, we can just pull this. Let's actually say that the margin does increase, the EBIT margin does increase, that it comes up to about, I mean, if they're focusing more on software, the margin will expand. So, because it's significantly more scalable. So let's go on 25%. G16. And I think this can be a significantly wilder swing than up here. So 90% and 110%. So that's the margin of for the bull and bear. The bull and bear scenarios. Sorry, I'm forgetting what I'm saying. No. $E. There we go. Do the same here. Yeah, looks good. Equals offset the cell that we're in, G93. D16, lock it in. Comma 0, close brackets. Fill it across. And take your revenue, multiply it by your EBIT margin. And there we have it. Forecasting the next 5 years of EBIT. Below, again, it's taxes. Percentage of EBIT. Copy them down to 2025. Pull that up. Let's go average. No, I mean, what did we do up here? This is good EBIT. I think they're going to have to be paying a proper tax rate. I'm going to go with 10% for the next few years. Multiplied by and this EBIT here, I mean, let's say it maintains that margin, but it grows to 23. Let's do that. So 23%, then it goes to 23.5, 24, 24.5, 25. So continual margin expansion. And if there is a bear case, we can see what that would look like if it was at 25%. So yeah, let's now calculate the EBIT, which is your earnings before interest, but after tax. That is simply, you take your EBIT minus your tax. And there we have it. Come down, let's bring back our cash flow items. Equals. The cash flow is going to be really good on this company. Just because, look, the depreciation dwarfs the capex. And you'll see in a second how we calculate unlevered free cash flow. Copy this. There. Okay. Unlevered free cash flow. Now, the unlevered free cash flow formula is you take your EBIT, you add back in depreciation and amortization because it's a non-cash expense. You then subtract capex, and you subtract change in net working capital. So let's see what that looks like. Take your EBIT, add back in depreciation and amortization, subtract your capex, and subtract your change in net working capital. Bold it, pull it along, and there we have it. Now, we want to find the present value of unlevered free cash flow. So how do we do that? We need a weighted average cost of capital. So that takes a little bit of time to build. So let's open up a new sheet. Again, do the formalities, remove grid lines, make a smaller, you don't need to freeze the first column on this one. Pull that up. IBM in the top. Let me zoom in. With data, stocks. And we still need this because we want to pull the market cap from this data. And then that means the model will update automatically on those types of, on that type of data. Because we can just go equals A1 dot market cap. Sorry, you need to divide by 1 million. Is the financial statements are in millions. Is that right? Yeah, got it. Now let's, okay. The WACC, so the weighted average cost of capital, equals your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. So there's some of these components that we can calculate quite quickly. Others, like the cost of equity, we need to go into a bit more depth. So market cap first. That's easy. We've got that. The market cap is the value of the equity portion of the company. So the way it's calculated is whatever the share price is multiplied by the shares outstanding. Below that, we want the percentage of equity, but we can't calculate that just yet. We then want the cost of equity, which we can't calculate until we've calculated the risk-free rate, the beta, and the equity risk premium, which we'll save this one until last. Then we want to know what the debt is, which we're going to get from the balance sheet here. So we want to take short-term debt, 7942 and 55174 equals 7942 plus 55174. So there's $63 billion of debt for IBM. There we go. Below that, percentage of debt. Cost of debt. Tax rate. Total. Then we get our WACC. So total is market cap plus debt. Don't confuse this with enterprise value. Enterprise value is market cap plus debt minus cash. Percentage of equity is now your market cap divided by your total. Your percentage of debt is your debt divided by your total. Cost of debt, we need to find where the interest expense is. Here. So 1457 will divide it by 4 multiplied by 3, then divide it by the debt. And that should give us what our interest rate is. 1457 divided by 3 multiplied by 4 divided by the debt. Double brackets this, otherwise it will come up with an error. 0.03, it's about 3%. Put this into a percentage. 3.08%. The tax rate, let's have a look to see if they've... It doesn't actually say what the effective tax rate is. So let's just go with whatever was paid last year. Let's go 10%. Now we want to calculate our cost of equity. The risk-free rate is easy. We just use the US 10-year. Let's see if I've looked at that. Okay, 1 second. Let me see. It's about 4%. Where is it? Bonds. 4.003%. The beta, okay. We now need to calculate. We need industry, unlevered beta. Come back onto the thing. Unlevered beta. What do we need? Revenues. EV to sales. Value. And what comes after value? It's proportion. Then we get weighted beta. Okay, so let's pull up our spreadsheet. We need to decide which industries that IBM operates. So the first one is quite easy. It will be software. Let's go software internet and software system and applications. Actually, it's probably more here. Then the next one is there a technology? No. Computer services. Okay, well, let's try those two. No. Okay, yeah. Let's go with those two: computer services and software system and application. The computer services we'll say is the consultancy side, and the software and system and application is everything else. We just need that first column, the average unlevered beta. Computer services, software, system, and application. 1.05, 1.31. Revenues for this one we'll just put as the consulting. Actually, let's do that plus the financing plus other. And revenues for software and system and application, we say software plus infrastructure. That's all of them. Okay. Now the EV to sales, we pull up this other spreadsheet, which shows the price, well, the EV to sales for ratio for lots of different industries. We said computer services. So 1.38 to 11.54. So the value for each of these is the revenues multiplied by the ratio, the EV to sales ratio. Pull that down. So the total value of the revenues, if you do it on an EV to sales, is 546 billion. So the proportion of that from computer services divided by so we can actually put this into a percentage. Copy. No, we want to go like that. The proportion multiplied by the unlevered beta. Just format them. Go number. Yeah, perfect. So the unlevered beta for IBM is 1.3. So equals H26. Sorry, 26 equals H26. There we go. The equity risk premium, come back to the 10Q. Go to our revenues. We want to go to the disaggregation of revenues. I don't think it was that one. It was actually close to the breakdown by segment. Here we are. Okay. So if we take these, we want, okay, country or region, revenues, ERP, weight, and then weighted ERP. I think that's what we want. I'll change it if it we go Americas, Europe, Middle East and Africa, APAC. Just copy these down. So 2381. $15,216, 8822. The ERP for each of these regions. Let's put up the risk premium spreadsheet. So for Americas, North America, Central and South America. No, they've been separated. It would have been good to get them together. So we'll take, okay, let's do Europe, Middle East and Africa. Easy, 6.22%. APAC, we will go, where's the Asia one? Here, 5.92%. Then the Americas. So if we were to go with Latin America and the Caribbean, 9.51%, and the US being 4.61%. I mean, the majority of this revenue is coming from North America, it's coming from the US and Canada. Then Latin America would be maybe 10% of that. We don't necessarily know for sure, but okay, we're actually regional simple averages. No, we want the weighted average because of where did it go? 1 second. What we'll say then is we'll say North America is 80% of America's revenue. No, we'll say it's 85%. So multiplied by 0.85, then we say LATAM equals multiplied by 0.15. Now we can give these two weights. So North America, 4.58%. LATAM, 9.51%. The weight for this one equals divided by here, but we want to go sum of course, that way we go be a percentage. Okay. The ERP now then for Americas equals the sum of these two. 5.32%. Okay, we'll go with that. Just sum. So the ERP for each region when weighted. There we go. Let's sum 5.72% equals. Okay. Now, the cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. So we go equals risk-free rate plus your beta multiplied by your equity risk premium. Percentage, there we go. And now the WACC is this formula that we've got here. And we've just calculated all of these components and we just put them all into this formula and we will get our WACC. So percentage of equity, so go WACC equals percentage of equity let's separate it into brackets just to make things a bit easier when the calculation is being done. Is your WACC is your percentage of equity multiplied by your cost of equity, close these brackets, plus open bracket your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate, and just double bracket at the end. And there we have it. You just format it to 2 decimal places, a WACC of 9.74%. So we come back onto our other spreadsheet. We say the WACC equals 9.74%. A bearish WACC is a higher WACC. So we will add 0.5%. We'll do the same over here, but we will subtract 0.5%, minus 0.5%. Now for the terminal growth value, we'll say 2.5%. This one, the bullish is, again, add 0.5%. And the bearish, minus 0.5%. Looking good. And we want to be able to, when we toggle the WACC and the terminal growth value, we want to see those here, the different amounts. So we're going to go equals, instead of offset, we go choose. And just put a comma after each of these, but make sure to do them in the order that we can see them. Where's it going? Okay. Perfect. WACC, terminal growth value. Now, let's start calculating our present value of free cash flow. 1, put again above the DCF, above the years that we're forecasting, put a 1, then just add 1 for each additional year until we get to 5, because we have to do to power to the number of years, meaning we need the we can't use the 20, 26, 27, etc. So the present value of unlevered free cash flow is, we take the unlevered free cash flow divided by 1 plus the WACC, but lock this in, close brackets, to the power of the year. Pull that across. If it's better, we can leave these unbold so there's a bit of contrast. Now your terminal value what we do here is we go equals, we take the final year that we forecasted, a free cash flow, and we multiply by 1 plus the perpetual growth rate, which is the terminal growth value. Close brackets, divided by your WACC minus your terminal growth value. Have I got that right? Yes, I was getting this wrong on the other one, so it's fixed now. Always do it this way. Your final year of forecasted cash flow, so for the fifth year, multiplied by 1 plus the perpetual growth rate, which is the terminal growth value, divided by your WACC minus your terminal growth value. And there we have it. Now, we want to work out the present value of the terminal value. It's always the same method. We just go the terminal value divided by 1 plus the WACC. You don't have to look this in because we're only doing it once, to the power of the final year, 5. There we go. Then we want to find the enterprise value. Here it is. Okay, the enterprise value is, you go equals sum, the present value of the terminal value, and all of these cash flows that we have forecast. The next step is we add back in cash and we subtract debt because we want to get to the equity value. So we know the debt is, because we've looked at it for the WACC, we just go onto our WACC page, 63 billion. Now, where do we find the cash? We find that on the balance sheet. Here. Cash and cash equivalents. That's what we want. And yeah, and marketable securities. So all of these can be, if they need to meet short-term liabilities, can be converted to cash pretty much instantly. So equals 11,569 plus 30 plus 3286. Yeah, I've got that right. Yes, I do. Now the equity value is, you just take your enterprise value, you add back in the cash, you subtract the debt, and this is the value of the company for the shareholders. We want to know what the diluted shares outstanding are. And from that, we can get our implied share price. So diluted shares outstanding are on the income statement. And it's down here, 947.4. 947.4. To get the implied share price, you take the equity value, divide it by the implied share price, and that gives us a value of $238 per share. Let's plug that back into the top. What's the, K124? Oh, I haven't done any of this, sorry. It was A1 ticker. The date today is the 25th. The current price is equals A1 dot equals K124. Okay, so if the current price is 307 and the implied price is 238, the up or downside, it's obviously going to be a downside because it's a lower forecast than what it is. So on a base case, we're saying there's a 22% downside. If we look at the bull of what we've forecast, change all of these to 3. Let's see what happens. Yeah, so on a bullish scenario, it's valued not actually that far from what we've built here. So yeah, I guess people we could say are very optimistic about the company at the moment, but providing all of these targets are hit, then on the bullish case, then the company would be valued at that. But on a downside, $183 should it go should the bear case scenario play out. So yeah, so I guess, I mean, people are trading IBM on a very bullish outlook for the company. So okay, cool. Well, that's IBM. Let's do the next one next week. What I might do, because there's a lot of companies reporting that we've already done. Alphabet, Apple, I can't remember, the Starbucks I think are reporting as well. So, and Chipotle. So we can just do a short video on those and update with the latest numbers and see how well we did on that forecast, or if the story is still the same from what we've built out. So yeah, I'll see you on the next one, guys. Bye, and don't forget to subscribe. Thanks, guys. Bye.